Good morning, everyone, and thank you so much for sparing your time today to hear about what is happening in global markets, what's happening in domestic markets for grains and oilseeds, as well as a look at fertilizer prices and how the sustainable farming incentive can impact your farming business. Now, we've done these events previously, and we talk about volatility in markets and we talk about uncertainty in markets. And that seems to have been the theme that has been the core message throughout my entire career in understanding what's happening to the price of wheat, barley and oilseed rape domestically. But it seems that today actually is the most truest form of uncertainty and the most truest form of volatility that we're seeing in markets. We've been through periods before where we've seen heightened impact of weather and other fundamental drivers on markets, but what we're seeing today is a huge influence from the world market that isn't just affecting price, but is affecting supply chains, it is affecting consumers, it's affecting the global macroeconomic view. And being able to navigate our way through this period is going to be crucially important for not only individual farm businesses, but our farming sector and the whole industry, and to a lesser extent, food supply and food supply chains in the whole country over the coming years. And that is exacerbated by this huge level of change that we're seeing to direct farm payments and the impact that we're seeing of the loss of BPS and the move to sustainable farming incentive and other schemes. So it's a really difficult time to understand exactly what is happening, what is going to happen, and what the impact on our farming businesses will be. And that's the real reason why we're here today, to discuss that, to have an open forum where we're able to put across our views as AHDB, say exactly what we think is going to happen in markets from a price perspective, but also look at the input side of things, as well as looking at the policy side of things as well. So before we start, I'd like to say thank you so much for everyone who's put all of their time and effort into developing this today. Thank you for all those that are attending. The structure today is we're going to run through a global market outlook from our analysis team for about 20 minutes or so. We'll then take a few questions for them. And then we're going to look at the impact of dealing with higher input prices, as well as a short review of the sustainable farming incentive. At the end of that, we'll have time for more questions and we'll be able to go into more detail over any topics that you choose. So without further ado, I will hand over to our analysis team and I'll hand over to my colleague, Megan Hesketh, who will start off with our global market outlook. So Meg, it's over to you.
Thanks very much, David. So first we're going to take a look at market outlooks for global grains and oilseeds, and then we're going to take a focus into UK grains and rapeseed specifically. What are the outlooks for those? So if I start us off with global grains, we're going to end, next slide please, carry on. Yes. So we're going to end this season and head into next season with a pretty tight supply and demand balance globally, and that's going to support prices across global grains, with a bullish outlook continued for new crop prices. So this balance was tight even before the war between Russia and Ukraine, but this conflict has supported prices, especially in the wheat and maize markets, where the markets are concerned around global available supplies of what would usually be exported. How long the conflict will last, well, that's unknown, but what is certain is the damage that has been created to infrastructure in Ukraine and the level of stocks that are remaining in the country. So it's created some storage problems and concerns to the quality of the grain stored as well. And we're going to take those problems forward into next season. So along with difficult trade dynamics, the market is still assessing the size of the harvest 2022 crops. So if we start with Ukraine, the war ongoing in Ukraine means that harvest area and production of grains overall is forecasted down 20% from the 2021-22 crop. Spring plantings are underway, but it is thought that wheat and maize area is going to lose out to buckwheat, barley, oats, millet this year. So it's not just how much goes in the ground that is important, but also how much is harvested as well. So that's definitely something to watch. Russian spring wheat area is thought to remain high, but questions remain around can they get their inputs, where will they get their inputs, and a question that's relatable to countries across the globe as well. EU winter cereals, they're in good condition for most of the EU. Pretty dry late winter, and there was a bit of a cold snap in the east of Europe in January, but there's been pretty favourable weather for spring planting as well, but production for the EU is forecasted down slightly year on year for harvest 22. The US is also super important to note. It's been pretty dry in some key winter wheat areas, and that's been impacting on crop conditions. So we've been seeing crop conditions fall of late. But on the other side of that coin, rain has been falling and slowing maize planting progress. So maize area is expected to lose out to soybeans in the US this year. And so rain at planting slows any hopes that any few extra hectares might go in, but that soil moisture will be useful to those plants once they're in the ground, and the outlook for May looks relatively dry. So with big concerns and question marks still around Ukraine for maize and wheat next season, who is going to fulfill that demand? Well, Russia have been fulfilling quite a bit of wheat demand this season. Russian wheat has been pretty price competitive. It's been picking up some quite good volumes, and looking to next season exports, Sovicon are forecasting exports to be actually up next season as well from this season. So potentially Russia, India, the EU, the US, they're all questions to ask as well. But US wheat has been pretty expensive and seems pretty expensive at the moment, and that's something to consider. And with high prices, can we see some demand rationing? Well, bioethanol margins still seem to be working currently, but mandate reviews will be something to watch, as will the price of oil and animal feed. Could we see some demand rationing? Well, livestock margins are being squeezed, not just in the UK, but in the EU and globally. So that's definitely something to watch as well. So to wrap up for global grains, the outlook remains pretty bullish for global grains in the new season. Prices are likely to stay volatile as we head towards the new season, reacting to any new news that might alter this balance. We can expect some harvest pressure in the summer, but overall we expect prices to stay relatively supported as we continue quite a tight supply and demand balance into next season.
Great there, Meg, but you mentioned maize quite a bit. So why is maize so important to this grain complex?
Yeah, it's a really good question. So in short, maize prices underpin the wider global grain complex. So we're looking at quite a tight global maize supply picture, and that's going to support wheat and barley prices as well as maize prices. So definitely important to consider. We are expecting Brazilian safrinha crop to satisfy some global demands as a pretty large global exporter. But is it enough to offset the disruption that we're seeing from the Ukraine? Well, Ukrainian maize exports account for about 14% of global maize exports, and so are pretty crucial to global availability. Like I said earlier, maize area in Ukraine is expected to lose out to other crops, and so production for harvest 2022 is forecasted down, and the UK AgroConsult are thinking that it might be the lowest crop since 2012, so that's definitely something to consider. And the US as well are a watch point, as I mentioned earlier. Maize plantings are expected to lose out to soybeans in the US this time, so rain creating that slow start to planting doesn't help with this picture of any extra hectares going in. So we're looking at a pretty tight global picture, Northern Hemisphere supply picture, and that's going to create quite a strong floor for global grain prices across the board. So that's a bit of a brief roundup for global grain outlook. What can we expect from the global oilseed outlook, Ant?
Oh, can we have the next slide, please, Karen, if that's okay. Thank you very much for that. So global oilseeds are longer term, much the same as grains. We've got quite a bullish outlook, which will keep this market inflated. So obviously we've seen crude oil prices rise significantly since the pandemic low. which has been driving vegetable oil prices and which has inherently been impacting oilseed prices. So over the next 6 to 7 months, there's a lot that can happen around the globe, which is highlighted in this map. So to start with, I just want to touch upon obviously what's probably in the news at the moment and dominating stuff, which is what's happening in Ukraine and Russia. So that's having large implications for the oilseed complex, as they are both net exporters of oils and oilseeds. Just a little parenthesis, they account for 80% of global sun oil exports, just to reiterate that these two countries are very important and they are going to drive oilseed markets. So since the beginning of the conflict in Ukraine, buyers have been searching for alternatives to sun oil, which has pushed up prices, especially for rape oil. And as we know, for this marketing year, we were in much short supply of rapeseed anyway, so prices have just gone higher. So there are a lot of unknowns around this conflict, but what we do know is the prolonged disruption and near virtual halt to the Ukrainian vegetable oil production and exports will continue to support this market going forward. Just to touch upon the crop prospects in the Ukraine. So sunseed planting, spring sowing, they're ongoing at the moment. A lot of production is actually grown in the eastern part of Ukraine, which has been significantly impacted by the conflict. Fieldwork is greatly limited and they're making it difficult to access inputs such as fuel, and also hindering farmers getting onto fields. So just moving on, I won't spend too long talking about Europe and Canada because Vikki's going to talk more in detail about this later, but these two countries are producing their respective rapeseed and canola crop for the next marketing year are critical for replenishing rapeseed stocks. Another part of the world, is the US, so soybean planting. So US ending stocks are only going to marginally recover for this marketing year. But for the next marketing year, prospective plantings, which were out at end of March, there's going to be 91 million acres of soybeans planted for the 22-23 marketing year, which is up 4% on last year. But what's a key watch point will be inputs such as fertilizer, ensuring that this big area produces a big crop. So planting has commenced now and it will ramp up in the coming months. So June time will be the critical watch point for planting soybeans. Moving on to the southern hemisphere, so South America. So we know the output for this marketing year has been drastically reduced from the second successive La Nina. Much of these revisions have been priced into the market, and the US has even managed to pick up some demand off these revisions, and they were forecast initially to produce record crops, which didn't come into fruition. So Brazil's soybean harvest is near complete. Argentina's is progressing. So for new crop soybeans in this region, we'll be looking at the end of this year. So from the start of October time for Brazil and mid-November for Argentina is when plantings will commence. But similar to the US situation, a key watch point will be surrounding fertilizers. So if fertilizer availability issues continue, it could constrain Brazil's expansion for the next marketing year, which will have implications on the second half of the 2022-23 marketing year. And further to that, we need temperate and South Pacific to go to a more neutral phase, so we don't have a hat-trick La Nina, which has brought the extreme droughts to parts of South America. So finally, I just want to actually talk about palm oil. Obviously, palm oil acts as the floor of this vegetable oil complex in most circumstances. So prices have been very reactive over what's been happening in the Ukraine, but there are also affairs within both Malaysia and Indonesia which have been impacting palm oil prices and bringing up this floor of the vegetable oil complex. So in Malaysia, there's been issues of shortage of labour, there's weather issues which has brought about flash flooding. In Indonesia, some news has come out last week and yesterday, we've had skyrocketing prices there, which initially led to export restrictions and then to a progressive levy tax on exports. And it was just announced last week actually that there's going to be a ban from this Thursday on palm oil, but it's not on crude palm oil, it's only on refined, bleach and deodorized products. So this is putting obviously another bullish spur into the market and creating a lot of unknowns on what could happen.
That's great, thank you very much, Anthony. So I guess what the key question is now, what is going to happen to oilseed prices going forward?
So oilseed prices, we're going to be expecting a bullish market into the 22-23 marketing year. So if Ukraine-Russia issues are resolved, the market will reduce but there'll still be an element of support due to, as you mentioned, Meg, about the grains. There's damage to industrial processing, logistics, port facilities, and this will have implications for exports for the next marketing year too. So tightness is expected on the world vegetable oil market too, and we're expecting inflated levels going into next year as well.
That's great, thank you very much. So if we pass over to Vikki and Millie on the domestic side for the market outlook. Next slide, please, carry on. Yes.
Thanks very much, Meg. Could we have the next slide, please, Carrie Ann? Thank you. So while we're not at the end of the 21-22 season yet, it's safe to say that the amount of both wheat and barley left to be carried into next season will be tight. In terms of what's in the ground for harvest 2022, according to the results of our early bird survey, the wheat area is projected to be up by about 1% at just over 1.8 million hectares, while actually the total barley area is expected to be down by 4% at just over 1.1 million hectares. Obviously, it is worth noting the early bird survey is based off planting intentions at the end of last year, and these areas may have changed since then. However, it does give us a good indication of what may be in the ground now. In terms of crop conditions, it has been reported that the majority of the wheat in the ground is in good condition, with few concerns at the moment. For winter barley, in general, the prospects are looking good, with some reports that there have been issues in the southwest. April has been a relatively good month weather-wise, which would have been favourable for spring plantings and allowed those to progress well. So if we look ahead to harvest and possible output, obviously there are a number of factors which could impact total production, weather obviously being the big one, as well as the rise in input costs, which Mark is going to actually discuss a bit later on. That said, if we use the area collected in the early bird survey and the 5-year average DEFRA yield, we could see a sizable wheat crop of over 14 million tonnes for the next season. For barley, however, unless we do see higher yields or more area than initially intended, we may see another circa 7 million tonne crop. Sentiment-wise for next season, we have obviously seen new crop wheat prices rising and the discount of new to old crop prices has been shrinking, which tends to indicate that the market is hedging that there will be a tighter crop next year. Despite a likely larger UK wheat crop next season, there will be tight carry-ins. And with the current tight global situation, imported wheat may be harder to get hold of. In terms of demand, the big watch point really is going to be bioethanol. It's expected that both bioethanol plants will be up and running at full capacity at some point next season. We may well see a shrinking back in animal feed demand as the pig herd finally starts to come back, and with tight margins from the laying sector. That said, it's unlikely to come back too much, with tighter barley supplies and maize currently looking unfavourable. In terms of barley, with a smaller crop and very small carry-in stocks, the barley balance sheet is looking to be tight again next season, especially with the brewing, malting and distilling sector now operating back up at pre-pandemic levels. Obviously, these are just very early thoughts, and a lot can happen between now and next season. But from a domestic point of view, weather will be a watch point as well as input costs. Domestic prices are very much supported at the moment by the global market, with prices very strong due to the tight global situation. As it stands at the moment, it looks like prices will remain supported going forward if the global situation remains the same and domestic demand continues to be strong.
Thanks for that, Millie. You flagged some really interesting points there, but in your mind, what are the biggest watch points to look out for the season ahead?
I think really, from my point of view, I think the big watch points will be around, from a demand point of view, will be bioethanol and whether actually the Virgo does come back up online and runs at full capacity next season, and whether both plants stay operating. Obviously, it's no one knows. And again, actually how much we see from the animal feed side, demand-wise, whether we see that margins have been squeezed so much that demand does lessen for cereals, and we see alternative feeding, or obviously depending on forage quality and turnout availability. And from a supply side, I think an interesting one obviously is going to be production. I know I mentioned obviously the early bird survey area and just did some scenarios, as you can see from the slide here. But it actually will be interesting to see what has been put in the ground and what inputs have been put on them to see what we could get. We have been hearing on the grapevine that the milling wheat margin isn't looking as favourable with the high price of fertiliser. So are we going to have the milling wheat crop this season? Again, that's very much sort of, I say, an unknown, but it'll be something that we'll see developing coming forward.
Thank you. No, that's really, really interesting. Thank you, Millie. So I'm just going to wrap up our market outlook session with a look at rapeseed. So if we could have the next slide, please. Thank you. At the risk of sounding like a broken record, the supply and demand situation is tight, as it is across most of the grains and oilseeds complex. So if you have a look at the current season first, so even prior to the outbreak of war in Ukraine, we were in a tight supply situation, and this had been really driven by the poor crop Canada had seen last year with the heat dome and the drought that they'd expected. And this season, we'd seen major exporters have their stocks to use ratio at the lowest level since 2012, 2013. So it was a tight situation. Since the outbreak of war in Ukraine, we've just had the tightness exacerbated. The reduction of sun oil availability on the market, as Anne mentioned in his presentation, Russia and Ukraine are, two of the world's biggest exporters of sun oil. Crushers have been looking for alternatives for sun oil and sun oil substitute, which has seen them turn to rapeseed and rapeseed oil. And this is why we've seen some of the price hikes since the outbreak of war at the back end of February. Coupled with that, we've also seen the price hikes in crude oil and palm oil for the reasons Ant explained, which provide the floor for the whole oilseed complex. So this has pushed rapeseed prices up all the more too. Crush demand has been strong, like I mentioned, because of using the lack of sun oil and rapeseed being used as the substitution there. We will see crush volumes down this year, but this has been because availability of supply has restricted volumes rather than actual attractive margins. UK prices we've seen increase more sharply than the EU prices, and this has been driven by the low domestic availability we've seen this season. So the UK margin has been less than the EU margin, and this is due to the higher seed costs we've seen. What we may see is, as we start to near harvest, we may see the prices start to soften slightly if it looks like the crop is progressing well and we have favourable crop conditions. But again, so much of agricultural price markets is weather related, so we will be really looking for favourable weather as we come into harvest 2022. Which brings us then on to new crops. So for the UK, for the EU, we are going to have historically tight opening stocks for rapeseed. The good news is that the EU area is up and conditions are good, which could lead to some replenishment of supply. The UK area is also increased as well, but only a little bit on last year, and it's still one of the smallest UK rapeseed areas we've seen pretty much this century. The markets are expecting a rebound in Canadian production, and in fact, it's later today we get our first look at prospective plantings from Canada. So we'll likely see markets react as a bit of a result from what's coming out of Statistics Canada. Ukraine, what is going to happen with Ukraine and Ukrainian production? Now, we had the Agricultural Ministry from Ukraine saying last month that they were hoping to harvest about 70% of their crop for this year. Now, that wasn't split down by crops, so we don't know what proportion of that would be taken by rapeseed, by maize, by wheat. But we know, because of the conflict, that there will be a downward revision in their production just because of their lack of ability to be able to get onto the lands and obviously the conflict that's ensuing at the moment. We likely will still see some Ukrainian imports next season, but the infrastructure that they're using to be able to get these out to their destinations is obviously very challenged at the moment, and the entire time this conflict continues will remain to be challenged. Equally, the entire time this conflict remains, we'll see the sun oil not coming out onto the global market, so we will still see markets looking for rapeseed and rapeseed oil as a substitution for sunflower, which will keep that demand there. So it's likely that even with an increased availability of rapeseed next year, with this strong crush demand, we could see prices supported at least into the first half of next marketing year. Second half of the marketing year, we might see prices soften slightly with the Australian crop coming online, and as soybean imports start to help alleviate some of the demand a little bit. But it is likely that these prices are still going to stay at these high levels. Even if we lose a bit of support, we're seeing historically strong price levels. So all in all, it's a very tight picture for old crop. New crop, the demand is still going to be there. So we're still going to see some tightness there, and prices look to stay elevated to the end of this season and really supported going into new crop, at least the first half of new crop too.
Thanks very much, Vikki. That was really interesting. So you talked a lot about the real demand for oil lately. What about the other side of the crush equation, and what's going on with meal?
Well, meal prices have also felt support, especially because of the conflict in the Black Sea at the moment. And again, it's the sunflower seed complex. So the lack of sunflower seed meal on the domestic market has just turned the markets to look for substitutes, of which rapeseed meal obviously forms part of that too. And prices have therefore been supported as a result. May see the relative attractiveness of rapeseed meal drop off a little bit as we come towards the end of this season, just because the price it's not as a price attractive as soybean meal, for example. However, all the while the crush demand is there. Obviously, we're going to see for rapeseed oil, we're going to see some rapeseed meal as a result. And with sunseed meal taken off the market, then compounders are going to be looking for that protein requirement to fill that hole, so helping support prices of rapeseed meal both. So that's a very quick roundup of what's been happening both globally and domestically and grains and oilseeds markets. Hopefully we've got some questions coming through, so I'm just going to pass over to David now, and he can help share some of these questions. We can help fill in some gaps of some of the knowledge. So over to you, David.
Great, thank you, Vikki. Thank you, guys. That's a really comprehensive review of everything going on in the market at the moment. And you may have noticed I've changed seats, mainly because I was annoying people in the office where I was sitting. So apologies for the slight echo, but I've had to go and find one of our little hidden rooms to hide in, just so I'm not annoying colleagues next to me as I talk out loud while they're trying to busily work. Anyway, we do have some questions coming through, but Vikki, if it's okay if I just sort of ask you a question first up, something that's been asked to me quite a few times over recent weeks. We've seen rapeseed prices go to €1,000 per tonne and above that. How high realistically can rapeseed prices go from these current levels?
Well, that's always the $64,000 question. And I think if you'd have asked people 12 months ago if they were going to see rapeseed prices at €1,000 a tonne, they'd have been looking at the end of the rainbow for it. These are historic high prices. We know that crush demand, at least for old crop, is still there, and literally volumes are just being constrained by availability at the moment. So all the while, we've got this lack of sunseed coming onto the global market and sunseed oil. There's going to be this demand there for other oilseed complex. That said, we're coming and we're approaching the EU harvest now, Northern Hemisphere harvest. So we might see that just take a little bit of steam out of these prices a little bit. I say a little bit because the crush demand still being strong, there's still going to be that appetite for it. But just with the hope, with these good conditions continue of favourable weather and a good crop coming out of the EU, the UK, I'd say we might just help contain any more stratospheric rises in prices in the short term. And then obviously we'll have that support once that steam taken out of them a little bit once new crop starts to come online a little bit more in the coming months.
Great, thank you, Vikki. We've had a couple of questions come through, so I'll just very briefly go through those before we move on to the next speaker, if that's okay. The first one is around milling wheat, and where do we see the availability for new crop of the right quality? So I suppose it's a question around new crop milling wheat availability and qualities, and probably coming from the fertiliser angle as well, related to potential reduction in fertiliser applications. But is there any view on new crop milling availability at the moment?
Shall I'll start off with this one, guys? So, like, looking at the crop as a whole, or like, you know, like I say, we could be in for, well, it's all pointing that way, like caveating the weather issues, no weather issues. If the weather carries on like it is now, maybe we need a bit more rain, but we could be looking at a decent crop next year. In terms of actually the quality of the crop, like I covered earlier, it will very much depend really on sort of the nitrogen applications, and I think Mark's going to talk about that in the next session in a moment. But we could see, because of the like the massive hike in fertilizer costs, we could see that farmers may skip the last application or reduce the last application, which may have an effect on the crop. But again, that it's a may and it is a has, because how much has already been applied so far. So it's an uncertainty of actually whether that is going to affect the overall quality. I think again, it's just going to be a wait and see game at the moment.
And I think to add to that, Millie, what we've been hearing as well is that a lot of farmers' applications, or their applications they're going to use for this season, has been dependent on when they actually purchase their fertilizer for the current season we're in just now. So if they bought back last May, June time, a lot of them are applying as per they would usually, being what the grain prices are just now. If they've bought a little bit further on the year and got hit by the fertilizer price hikes that bit more, then there may be some more considerations more around the saving some to use for next season because of the cost of replacement. Like Millie said, Mark's going to touch on that, rather than the actual premiums they're hitting now.
Great, cheers guys, and as ever, the beautiful British weather will be the one of the main factors as well as we go through the summer months. I've got another very brief question, if that's all right, just before we move on to Mark and talk about input prices, and it's sort of related to the same subject, so a nice little segue into the next section. But do any of you have any view on if the current high prices are enough to cover the increased costs of production? So, you know, are we seeing a sufficient margin in the, I suppose, talking about harvest 22 and harvest 23, relative to where current prices are at the moment? Any view on that? Or is it that uncertain?
From a personal perspective, I think looking at it, doing sort of some back of the envelope calculations as we have been doing of late, and listening to what's been sort of going around and hearing what we've heard from the ground, actually no, it's all relative. The price rise, the fertilizer rise, we're seeing that gap close. So while I think from my point of view, it possibly the price rise isn't compensating enough for the rise in inputs.
And I think for me, the key watch points are what's going to be drilled this autumn, so for harvest 23 as well, because that's when a lot more growers are going to potentially be hit by the higher input costs when they start to buy potentially their fertilizer when the books open this summer. They may have been a little bit more shielded by them if they'd bought 12 months ago. So I think we will see repercussions of this going forward, and harvest 23 still is going to be a real watch point, and potentially beyond.
Yeah, I would agree, because we are seeing some quite good prices on NOV 22, NOV 23, but it's all relative to where you are, and it's important now more than ever knowing what cost of production is and knowing where sort of you are at, and where you'd be comfortable making a margin on. But yeah, definitely harvest 23 will be a big watch point.
Great, thank you guys. We'll have to put a stop to the questions there, because we need to move on to our next speaker, but we've got a good chunk of questions that have still come through, and we definitely have some time at the end, so we'll come back to ask a few more questions later on. But thank you all for your review of the global and domestic grain and oilseed markets, and we'll see you in a little bit for some questions. But we'll now move on, following on that question around input prices, to look exactly at that. And I'll hand over to my colleague Mark Topcliffe to review how we can all deal with the higher input prices. So Mark, we'll hand over to you. Thank you.
Thanks, David. So next 10 minutes, we're going to look at dealing with these higher input prices. So I'm going to manage expectations now, really, and say there's no silver bullet in how we offset these higher cost of inputs, but there are a range of things that we can do to help mitigate the situation. Again, I don't think anything I'm going to suggest is a surprise. All the ideas I put forward are those that have been carried out by growers that certainly I speak to, or reported by farmers out there. So there's a sort of a list of ideas that I'll present of short-term strategies, and then a sort of medium to long-term strategies, and hopefully they'll provide some reassurance for those who are already doing these things and a reminder to others who are not. So next slide, please. Just to put into context where we are in terms of the input prices, you know, lots been said already about fertilizer, of course, and that's by far where we've seen the greatest increase in the prices. So this is just a chart just showing the trend in the index of the prices of these sort of key inputs: seeds, fuel, fertilizers, fungicides, and herbicides. And so you can see there, fertilizers is probably near enough triple in terms of what it was 12, 18 months ago. So it's a stark reminder in terms of where we are at the moment in terms of those input costs. Next slide, please. Just to try and put into context then the sort of impact of those higher prices, let's just have a look at fertilizer costs as an example, because it's certainly one of those key ones that we're talking about at the moment and very topical. So what I've done here, we've taken the results of our farm bench users, which in 2021 they reported their fertilizer costs on a per hectare basis around about sort of between £113 per hectare to about £192 per hectare, depending on what type of crop it was. So that's the blue bars on this chart. Now, if we take the amount of fertilizer applied in that 2021 harvest year, and we apply to that the cost of buying fertilizer back in last summer, the sort of June time-ish, then a sort of estimate for 2022 harvest year fertilizer costs would be at least £50 per hectare higher, typically in the sort of £70 to £80 per hectare more than what it would have been last year. However, if you purchased the fertilizer last autumn and again applied at the same rate as what you did last year, this year's harvest crop, then we could have seen, you know, significant increase of fertilizer costs up to £200 per hectare, depending on again on the crop type. So it just re-emphasises just the impact of where we are with these higher input prices at the moment, and how crucial it is to try and see how we can mitigate these huge increases in prices. Next slide, please. So let's start by looking at some short-term strategies. And these, I could say, you know, a lot of these things, I think many of growers that are listening to this webinar will be doing already, but you know, it's a good sort of reminder of these things, and say reassurance that you're doing some of the things which are, you know, would be good practice to try and mitigate the high input prices. I think the first thing to do is just on a daily basis, just question what you do and everything that you do, and why you do it, and if it's really necessary. Is there something you can do that's different to what you traditionally would have done in previous seasons? You know, we're in a different situation this year with the high prices. So is there something you can do which you haven't done previously, which might help mitigating those high prices? Now, in a normal year, shopping around for inputs and services and other suppliers would probably fruit quite well. But in the sort of situation where we are at the moment with the high prices, you probably get less sort of gain from shopping around at the moment, but it may well still be useful, if nothing else, to reassure you whether you're getting some of the best prices from your suppliers anyway. So again, maybe just get a couple of quotes just to find out whether you are getting the best prices that you can. The other thing is to work out what you can afford. So look at what your current input prices are, and compare that to what your sensitivity of output prices is. So look at a range of output prices. The team have just been discussing about what prices might be doing over this next sort of year or so. So look at ranges and seeing whether you know the sort of inputs that you need to put into those crops could be afforded by, you know, those output prices. The other thing is looking at sort of your fertilizer and chemical application rates and timings. I know a lot of growers have been doing this and looking at adjusting what they've been doing, and it's a good short-term sort of measure to try and again, reduce your reliance on some of those inputs. And we've got a range of tools in AHDB to help with that. And I'd really encourage you to go and search these tools out and help with your decision making around those applications. I'm just going to focus on one now, which is the nitrogen fertilizer adjustment calculator. So we can move on to the next slide. So if you go into the tools section on the AHDB website, on the main page there, and then you just scroll down to the nitrogen fertilizer adjustment calculator, it's up there. And what that will do is then take you to a page where you can download a sort of spreadsheet tool where you can put in your own figures. So if we move on to the next slide, I'll just demonstrate what that looks like. So this spreadsheet can look at what you'd need to do to apply your economic optimum of fertilizer for our cereal crops or oilseed crops, separate sort of tables where you put in crops. So this is running through an example here of a winter wheat crop, and what you do then is put in your fertilizer price, £785. Next slide, please. And then just add in there the content, the nitrogen content of that fertilizer, what you expect to get to sell that grain at. And then what this calculator does, it calculates what your cost of fertilizer, but crucially it calculates that break-even ratio, which is looking at what your economic optimum is. And what it's saying in this situation at those prices that we put in at the top there is that it recommends, if you are applying the recommended amount, recommends pulling that back by 35 kilos of nitrogen per hectare. Now, there's an impact on that, and we've also got that sort of highlighted there. So yield obviously come back, and this is based on work on yield responses, and also because of that, you're going to have a reduction in crop income. But actually, there's going to be a saving in fertilizer costs. So the difference between that reduction in crop income and fertilizer costs means actually in this situation there'll be a net gain. So it's worthwhile cutting back on the fertilizer if your figures are sort of similar to this. But it's worthwhile going into the tool and seeing what your figures are for your particular situation, depending on what you bought your fertilizer and what you may expect in terms of grain. Next slide, please. And what you can also do is just add in a couple of extra figures here. This is just looking at your nitrogen application rate, which you typically would apply, what area you've planted that particular crop, and then it just works out what your adjusted application rate would be for nitrogen and the total amount of fertilizer product that you'd need for that area. So hopefully it provides a lot of useful information there, very easily and quickly with just a very few figures. Next slide, please. So let's have a look at medium to long-term strategies. I'm not proposing to go through these in detail. I'm sure a lot of these are already aware of what these are in terms of those people listening in and this. And a lot of people, I say, will be already sort of implementing these. But I think it's something which longer term, more and more growers will be looking at doing some of these strategies to try and look at reducing that impact of the input prices. It's something which I don't think we're going to see input prices reduce significantly in certainly the short term, or maybe in the medium term. So looking and reviewing what we're doing as a system as a whole, I think is probably what we're looking to do, so we can then adapt to what may be the new norm in terms of the level of prices that we're seeing. So each of those things there all would contribute some way to reducing the reliance on inputs in different ways, and we've got a lot of information on the AHDB website around a lot of these things, so do search that out on that. To say, we could probably spend a whole presentation, a couple of hours just looking at these different strategies. But one of the key things I'll just end off with is just look at the cost of production. I think it's certainly in times like this, it's really useful to know what your cost of production are, because from that you can then see what the impact will be on your margins if you've got to increase the cost of your inputs for whatever reason, and then comparing that to whatever the output price is going to be. So I think doing some monitoring of your cost of production is a key thing, and benchmarking against others to see that you're operating at the most efficient level that you can for your particular situation. Next slide, please. The other thing I just wanted to bring up was this, the characteristics of top performing farms, because no matter what seems to be going on in the marketplace in terms of prices, etc., those farms that do well always seem to do well. The top 25% do have a particular set of characteristics. And we've got 8 labelled here. This is following on some work which was done about sort of 3 years or so ago, published in this Horizon report that you can see on the screen. and it's again worth sort of looking into that. But these are key areas where, you know, if you're sort of doing these things over that medium long term, you'll get the sort of payback in terms of the business profitability. I visited a sort of discussion group of growers over the winter, and we were looking through the sort of figures, cost production figures for mainly their wheat crops. And there was one particular grower who really stood out in terms of his net margin. It was fantastic sort of figures, and it was asked of him sort of, why do you think you've done so well in that? And he simply replied, attention to detail. It was just sitting down and going through every aspect of what he did, questioning what he did, and really reviewing everything and going into the fine detail and everything. And that's what enabled him to really hone down his costs and really maximise that margin for that. So these are a range of characteristics which, again, I'd encourage you to try and look at seeing how that could fit in with what you're doing and seek out this Horizon reports on the AHDB website. Next slide, please. So just to finish with some key messages then. So firstly, review, reassess every aspect of your production system, go into everything that you do and just reassure yourself where you really need to do what you're doing or whether there's things you can change. As well as doing that, you need to then monitor, look at how things are changing in terms of the prices and the output prices, etc., and what that might mean for your margins. And use the tools that we've got available in the AHDB there. You know, they're free to use, and they'll be extremely useful in decision making around a lot of these inputs. So that's all I've got to say. So I'm happy to take some questions.
Thank you, Mark. In the interest of time, Mark, if it's okay, we're just going to move on to our next speaker first, then we'll review questions at the end, if that's all right, just so we can wrap everything up, because I'm doing a distinctly average job at chairing the session and we're already slightly over time. So we will come back to some questions that a couple have come through. But if it's okay, we'll move on to our next speaker and we'll head over to David Swales. David is our Head of Strategic Insights at AHDB, and we'll be reviewing the Sustainable Farming Incentive for us, the costs and choices for arable farms. So David, I'll hand over to you. Thank you.
Fabulous, and good morning, everybody. I'm billed on the slide as being Amandeep Purwell, but as you'll notice, I'm not Amandeep, so I'm a bit of a last-minute substitute today. But yeah, I need to give all credit to Amandeep for this work. I'm literally just presenting her slides today. We thought it'd probably be interesting just to change focus a little bit away from the current market situation and some of those pricing issues which are affecting you all, just to spend a little bit of time considering some of the longer term changes which are happening with agricultural policy in England. And we've recently conducted a big piece of work looking at the Sustainable Farming Incentive. And my aim today really is to share some of the headline findings which we've had from that piece of work. It's a very big piece of work, and I've only got 15 minutes today, so I'm going to try to just pull out one or two of the key issues which I hope will be of interest to you. So if we move on a slide, just to remind everybody, the Sustainable Farming Incentive is one part of DEFRA's new ELM programme for England. And SFI is a strand which is focused very much about rewarding farmers for doing environmentally friendly activities and sustainable actions on their farm. And it's perhaps the most farmer focused of these new schemes which are coming through. There are other schemes which are kind of reaching the sort of pilot stage at the minute, those being local nature recovery and landscape recovery. But those schemes aren't just for farmers. They're likely to involve other landowners as well. And if farmers are involved, they will have to collaborate with those other landowners. So these schemes as a whole aren't intended to replace direct payments, but we are very conscious that our levy payers are kind of looking at all of this changes and thinking about, well, what does it mean in terms of direct payments declining? And a question we often get asked is, will these new schemes replace the income I'm losing from my direct payments? Will they help me plug the gap? And I think a really important finding from some of our work is that, I mean, it looks to us that it won't fill the gap for you. So a really important thing to consider is, I mean, it might help to some degree, but there are other things which you will need to do to fill that gap with direct payments. So, and we look at some of that within our report. If we move on the slide, what I'm going to focus on today, SFI is a very much a pick and mix type scheme, and there's a whole variety of different standards which have either been piloted or being introduced this year. We thought it'd probably be worthwhile focusing on aspects of the scheme which are being rolled out to everybody this year. So we've called those the SFI 2022 standards. And you can see here there's three main standards being made available this year, which are listed. So the arable and horticulture soils and the improved grassland soil standards, those are available at an introductory level and an intermediate level. And there's also a moorland and rough grazing standard. So these are basically open in the spring for people to apply and get involved if they so choose. And DEFRA have published what the headline payment rates are, which you can see here on the slide. A really important question we wanted to ask in our work is, well, John, we know what you're going to get paid, but how profitable are those standards going to be? So, John, given the sorts of actions you have to take on your farms, they're going to obviously have a cost to you. So how much sort of profit margin are you likely to make on those different standards? So, I mean, I'm going to drill into a couple of these standards now and hopefully answer that question. If we move on the slide. So to give you an example, firstly, on the arable and horticultural soil standard, this has two levels initially this year. There's going to be an advanced level introduced in the future as well. But you can see here at an introductory level, there's a requirement to test your soil organic matter and have a soil management plan. And then there's also a requirement to have a percentage of your area with green cover over winter. And you're required to add organic matter to your soil over time. The intermediate level is pretty much the same as that. So those requirements are still in place. Plus there's an additional requirement that at least 20% of your cover crop has to be multi-species. So what we've done in order to try to assess the cost of those actions is we've looked at a set of virtual farms. So these are meant to be kind of representative farms. They're not high-performing farms by any means, but they're representative, we think, of different aspects of the industry. So there's a large farm in the east of England, a slightly smaller arable farm in the southwest, and a smaller farm in the east of England. So these are farms we've chosen to hopefully give you a bit of a feel for what the cost of these things might be for your farm. But yeah, things will vary from farm to farm, and I think that's one of our key findings. So if we move on a slide, what we've done across those three farms is we've then tried to assess what the costs and benefits of that standard are financially for the farm. So the dots along the top here are at £22 per hectare. So that's the gross payment which you'll receive from DEFRA if you undertake the actions. And then we've shown in the bars along the bottom over a 3-year period for each farm what the actual end up net payment will be. So once we've factored in the costs of doing those soil assessments and establishing those cover crops, once we've factored in those costs, how much profit will there be at the end? So you can see very similar pattern here across the three farms. And the costs are slightly higher in the first year because of the requirement to do those soil assessments, which you don't have to do in years 2 and 3. But you can see broadly the farm is making sort of just over half of the payment they make would be profit for that farm business at an introductory level. If we move on to the intermediate level, you can see it's a similar picture as well. If we move on a slide, please. Magic. So very similar pattern there. So there is obviously a higher payment here of £40 a hectare. and the net payments are also slightly higher. So basically the sort of net profit from this standard we worked out is around about £5 per hectare more than at the intermediate level. So you need to do more for this standard, but potentially you get slightly more profit back at the end, and a very similar pattern. What we wanted to do is then look at, well, what that meant in the grand scheme of things in terms of the sort of profitability of the farm business as a whole, and we've done that on the next slide. And you can see here the blue bars show the sort of baseline of the sort of profitability of that farm over a 3-year period, and you'll note the farm's profitability is falling over these 3 years, and that's purely an effect of the basic payments being reduced over this time period. And you can see here at an introductory level, this scheme basically, or this standard, adds sort of slightly less than 1% to the farm's profitability, and at a intermediate level it's slightly more than 1%. So in the grand scheme of things, it's a very modest impact looking at this individual standard on its own. But a really important point here is for each of our virtual farms, we were able to accommodate the actions required from this standard without altering the farm's rotation of crops. So they were able to accommodate this requirement of 70% of cover crops relatively easily, and that won't be true for absolutely every farm. So on the next slide, we've also then looked at what would happen if you did have to take some land out of production in order to achieve what's required in the standard. And you can see here the pattern is a very much a different one. So the cost of taking that land out of production at this moment in time, when we know prices are really high, is actually quite negative, and potentially we see for this farm a drop in the farm's profitability of between 3 and 4%. So a really important point here is really important to look at the requirements of each of these standards and think about what the impact of it would be on your farm, because just because you're getting paid, particularly if you have to take land out of production, it may be the payment you're getting won't offset all of the costs you will incur from getting involved with the standard. That's a really important point. If we move on then, we thought it'd be also interesting to briefly look at the improved grassland soils. I appreciate I'm talking to an arable audience, but I imagine many of you may well have mixed enterprises, and grassland soils may be an option for you, and potentially it's a slightly different picture than what we saw for the arable soil standard. So here you can see the standards. Again, there's a certain similarity here. There's a requirement to test your soil, so to test the organic matter and have a management plan in place. And at an intermediate level, there's this additional requirement to establish like a diverse sward or herbal lays on a proportion of your land. So we've looked at this for a 220 hectare mixed farm. And on the next slide, you can see at the introductory level, a similar graph to we saw before. But again, the picture here is slightly different. So again, there's an initial higher cost. So the year one costs do take away from that gross payment. But then once once you've done those tests, you don't have to do those in subsequent years. So in the case of this standard, we felt most, if not all, of that gross payment would actually be profit for the farm after year one. And again, if we move on to the introductory level, you can see a similar picture here. So in year one for the intermediate standard, there's quite a high cost because you have to establish herbal lays on a proportion of your fields. But yeah, after that's been established, in years 2 and 3, you won't have to do that again, and potentially nearly all of that gross payment would be profit to you. So this really does demonstrate, just looking here at 2 standards, that actually there's a very different outcome and a very different level of profitability across the 2 standards. So, John, we look at this in a lot more detail in the report, which I'm going to highlight at the end so you know where to get to the detail. But really important, I think, to have a look at what the standards are and try to sort of work out what that might mean for your farm and what the costs would be. So yeah, if we look on the next slide at an overall farm level, you can see that this particular standard, I mean, in our view, for our model farms, made an awful lot of sense and would add to that farm's profitability. So between sort of 2 to 3% increase in that farm's profit in year 3 at the introductory level, and potentially as high as a 7% profit at the intermediate level. So yeah, if we move on to the next slide, I'm just going to finish with a few key messages for you. So certainly for farmers, John, I think our key message here is the SFI standard is an important new source of income for you. And potentially if you're already doing a lot of the actions required in these standards and your farm is kind of set up so you don't have to make many changes, it may make a lot of sense for you to get involved with SFI, and it could mean quite a bit of profit for your farm enterprise. However, I think it's really important that you work out what it means for your farm. So we did look at the example where a farm had to take some land out of production, and that had quite a detrimental impact. So really important to have a look at that detail, have a look at the report we've published, and try to work through what that means for you. But certainly, John, although some of these measures are profitable, it's very clear to me that the SFI will not replace what you're expecting to lose over the next few years in terms of direct payments. So important to think about other strategies, John, be it getting involved with some of those other schemes which I mentioned, increasing your efficiency, or maybe diversifying as ways to fill some of that income gap. John, we're also sharing this report with DEFRA and the policymakers there, and some of our key conclusions for them really is around the level of payments which they're offering. And to be fair to DEFRA, they have made quite a few changes between the pilot scheme and the 22 standards which I spoke about, and tried to tweak them and make them more desirable for farmers. We think they've probably still got a little way to go there, particularly if they want to get 70% of farmers signed up. So fingers crossed, DEFRA may well be looking at those rates, and hopefully they become a bit more generous over time. So yeah, just to leave with a final slide, just to highlight, Joe, what I've been talking through today is our latest Horizon report, looking at the sustainable farming incentive. You can get to this on our website, and we look at a whole range of standards within there, as well as the two I've focused on today. We will include a link to this in an email which you'll receive shortly after the session today, so you can sort of get to it directly via that link if you need to. But yeah, happy to answer any questions you might have, and hopefully you find it interesting.
Thank you, David, and thank you everyone for all of the questions that you've sent through. David, that was really interesting. But don't worry, I'm going to give you a break for a second so you don't dive straight into questions. I'm going to pick on our first set of speakers, if that's okay. If I invite Vikki, Meg, Millie and Ant to come back as well, just to follow up on an earlier point that was made. We had a question come through earlier that was asking around ethanol plants in the UK, and what has changed their minds to bring them back into operation, considering we see so high grain price at the moment. So what's driving that reason for that ethanol market to restart in the UK?
Yeah, I can take that one. So interesting question. So I think the first very important point to flag is demand. It's there for bioethanol. So with the introduction of E10, we've seen a comeback a bit ago, and I understand there will be challenges for plants with high wheat, maize costs, but it is important to consider margins overall. So we're looking at rising crude oil prices, DDGS prices are pretty strong at the moment, considering high feed costs, CO2 prices. So there's quite a few wider elements that are playing into this picture that we are seeing currently, that are working towards making margins making sense. Globally as well, that's the picture that we're seeing. So bioethanol production in the US has been rising. Stocks have been rising as well, but they're hoping to export out to Brazil, some ethanol as well. So not just a UK picture on that bioethanol front, but yeah, mandates will definitely be something to watch for us, and also longer term sort of crop caps, but at the moment margins seem to be making sense.
Cheers, Meg. Thank you. We've had a few questions come through, but as ever, we've got plenty of time now. We've booked a good 20-25 minutes for questions at the end if we need to, so feel free to keep sending them through on the dashboard. Mark, is it okay if I come to you with a question now, looking slightly further forward to 23-24 season, so harvest 23? How big is the risk of that being a high cost but low output year for arable farmers, do you think?
I think there certainly could be a risk of it being a high cost year. So if we think about what's happening this year, those growers who bought their fertilizer back in summer last year have some way sort of been shielded from the higher cost of production in this current harvest year. So when they come back to buy the fertilizer this year, if they haven't had any left over, then they're obviously going to be buying at the higher rate. So the harvest 2023 crops, they're looking at high costs certainly. It's not looking likely that input prices like fertilizer will come down significantly anytime soon. So gas prices are obviously still remaining high and seem like they're going to be like that now for a few months from what we're getting intelligence on. So we can't see fertilizer price certainly coming down. So it's looking like it could be a risk of a higher cost year next year feeding through. I think in terms of the output side of things, obviously it just depends on what happens in the markets, of course. I know the team have been discussing that. I mean, if you look at the futures prices at the moment, they're still for next year higher than what they were last year for prices received. So, relatively speaking, could say the output could be a bit higher, but relative to the costs, would it cover that? And it's one that everybody sort of needs to look at in terms of, and that's why I sort of mentioned it in the presentation about look at that sensitivity to your output prices that you could be receiving for your crops relative to the costs that you've got to see whether that's going to have an impact for you or not. I think the other thing just to raise as well, because this will impact profitability for growers in England, is the fact that the BPS will continue to reduce next year as well. So that's obviously going to have an impact on margins overall for farm businesses in England. So there's a bit of a double whammy there in terms of possibly higher costs. We'll see what the output prices do, but reduction in the government support.
And I think it's about having about having a look ahead to prices that we'll see for the 23-24 marketing year. So if you look at NOD 23 prices already at this point in the contract, they're trading at record highs at this point in their contract. And since the contract was launched, they've gone up 75, 76 quid. So they're already feeling some support for 23-24. So whether the markets expect that demand, that tightness there. But obviously the focus is going to be on next marketing season, but it's thinking ahead to 23-24 as well and looking down the line.
I think that's a really good point, Vikki. That's something that we've spoken about internally quite a few times, isn't it? About when we're looking at these high costs, that we just have to think of them in that context of the price further forwards and locking that in. And sorry, you can say something there as well.
Oh no, I was just saying there's a lot of stuff that can change a market. You've got high input, high prices at the moment, but you get semi-bearish news that Russia are planting a record crop for next year. We've got a record Russian crop coming and increased exports, which depending on what happens in the Black Sea could change the tide of the market. So when it gets round to actually selling your 23 crop, you might have purchased very high price fertilizer and not be selling for maybe as high as it is now. But there's a lot that can change between now and then, and I don't have a crystal ball to answer that question.
Definitely, but it's, half of the thing is ensuring that if there's a decision that's being made, that there is a margin within it, and protecting that margin is the key. Definitely. Great, thank you guys. David, if it's okay to come back to you now to just do a few questions on the SFI project and Horizon reports as you were just discussing then. One question's come through just asking if we've included any management time in the SFI costings.
Yeah, so certainly, do you know what I mean, the sort of time and the cost of your time is a cost. So yeah, we've tried to factor in the sort of time cost for doing the actions required. I think it's worth saying, do you know what I mean, the report looks at, do you know what I mean, a whole load of, do you know what I mean, attitudinal views, and do you know what I mean, we spoke to a lot of farmers working with Harper Adams University to explore what they felt about the SFI pilot and things like that. And do you know what I mean, what we probably haven't included is a cost for that sort of hassle factor of dealing with DEFRA and getting the paperwork in, just the sort of transactional cost of getting involved with these types of schemes as well. So I think for that reason, it's partly why, John, we think that the sort of profit margins available are quite modest. Once you factor in the sort of hassle factor of having to fill the forms in and everything as well, it probably explains why not that many farmers have got involved with the pilots up till now. And with high prices in the market, as the guys have been explaining, probably explains why the standards aren't that appealing to many farmers at this moment in time.
Great, thank you. I should make it clear as well in terms of the questions that are coming through, because we've had a lot come through in the last 2 or 3 minutes or so. If there's anything that we don't get around to answering today, we'll be putting a document together to review those. And also we're going to be reviewing the content that we've presented today in the Grain Market Dailies for the rest of the week. So there might be an opportunity to answer some of the questions in those. So if we don't get around to your question today, don't worry, it's not that we're ignoring you or favoritism. We will get around to answering them in the coming days. So David, if it's okay just to stay with you on the SFI, I've just got a couple of other specific questions. Someone has asked if they can use already established winter sown crops for cover crops. Do you know the answer to that in the standard? Are they allowed to use those already established winter sown crops?
Yes, yes, they are. So basically, and this is probably my key point, is the effect of some of these standards and the sort of amount of change some farmers will have to make will be much smaller than others. So, I mean, you can get to a lot of the details on these standards on the gov.uk website. We linked all of that information from the AHDB website. So, I mean, in essence, if you look at these actions and think, well, actually, I'm doing a lot of this already, or I meet this standard, then it makes perfect sense to go and get paid, because you're already doing what you need to do. If you look at the standard and you're having to make all sorts of changes on your business, and particularly if you're having to take land out of production, then I mean, I would probably say it maybe doesn't make that much sense financially at this moment in time. But yeah, really important to have a look at that detail.
Great, thank you, David. If I could go back to the analysts who talk about global markets at the start, guys. I've got a question come through about Ukraine, and specifically the wheat that is being held in Ukrainian stores and imports at the moment, which is believed to be in the region of 9 million tonnes, the question points out. I think the question is really asking, if that wheat were to come back onto the world market, what would the impact on us be if Ukraine were able to trade physically in a normal way and able to ship that wheat into the world market?
Yeah, I can start off on that one. I think, as I mentioned earlier, I think there's a couple of issues with it being stored. So about the quality, whether that's keeping it the same quality and for how long it is to be stored. We know that some is getting out of the country at the moment by rail movements, but there's quite a bit of a backlog. So how much is moved, how quickly it's moving as well. So I think the storage of that grain and the quality is definitely a key issue. And also with storage availability, what does that mean for next season as well? So like I said, potentially plantings might move to other crops. So how much we will be seeing production wise next harvest, as to sort of whether we are seeing a movement from that storage grain and how much we'll be getting next harvest. But I think it's really those big questions around the quality and when it actually can leave the country, because we're seeing huge problems with infrastructure. I don't know whether anyone else has anything to add, but I would say those are the key problems.
Just to add to the infrastructure point, Meg, even if, and we all pray and wish it was so, that the war was going to end tomorrow, the damage that has been undertaken to the infrastructure, the roads and the rails that are apparently the focus of the campaign at the moment, the kind of landmines or the issues there we're hearing in the Black Sea, there are still going to be those challenges there. And even when this war ends, there's going to be those challenges there for some time forward, which will just impede volumes coming out of Ukraine.
Yeah. Great. Cheers, guys. David, if it's okay if I come back to you with another question, not necessarily related to SFI, but looking about BPS loss. I'm just saying, have we done any work or calculations around the degree that the commodity values would essentially compensate the losses from BPS? So if there's a market-based correction outside of the government activity and intervention.
Yeah, so that's certainly something we do look at, David. And I know DEFRA they publish data on an annual basis from their farm business survey, looking at farm business incomes across different sectors. And the last report they put out on that, I think, showed quite a big increase in overall farm business incomes, which they attributed to those higher commodity market values. So, do you know what I mean? Do you know what I mean? That was happening at a time when the direct payments had declined slightly. So direct payments are important, and we only had like a very modest, I think for most farms it would have been about a 5% deduction in direct payments last year, which would have been more than offset by that positivity in commodity markets. Now, do you know what I mean? We've obviously heard a lot about a lot of bullish predictions from the team around what's going to happen to prices over the next year or so. But yeah, I think it's important for farmers to think, do you know what I mean, about the whole transition period, and direct payments are being phased out, do you know what I mean, over the next 6 years now. So, do you know what I mean, I think it's have a bit of a longer term view as well, would be my view. And do you know what I mean, these high prices, do you know what I mean, sound like they're going to stay for at least the sort of short to medium term. But do you know what I mean, in 4 or 5 years time, the world market might look very different. And just maybe have a think about planning based on a more normal price scenario, what that might mean for your business. It would be dangerous, I think, to assume high prices are here to stay forever.
Exactly, there's the old economist line, isn't it, that the cure for high prices is high prices. Along with inflation being transitory and all the other cliches that come out in these volatile times. Anyway, Mark, if it's okay if I come to you with another question that someone has posed around the increase in working capital, and I think it's actually a really pertinent point that's been put across, that's with the purchasing practices of purchasing farmer, we could see purchasing fertilizer rather, we could see twice or more the requirement for borrowing, and the impact on working capital is going to be pretty huge. Have you got a view on that working capital side of things for arable farms at the moment?
Yeah, I think that's right. It's a good point, and it's going back to what I said about the previous sort of risk of the high cost that we've got. I think yes, that working capital will certainly be higher, and I'll put some pressures on some of those cash flows for some growers, certainly. So it's again, it's, you know, look at what the impact of that will be, have a good grasp of that. If you're not already sort of doing some budgeting, for example, then look at what that might mean for you in terms of the current prices we're seeing, to have a handle of what that working capital impact might be for you. So certainly, yeah, I think there's definitely risk in terms of that. You know, a greater use of overdrafts in some cases, so obviously then possibility of higher interest rate charges, etc. So yeah, no, it's a good point.
Great, thank you, Mark. I'm conscious of time, and we're coming to the end of our session, and I have a long list of things that I need to remind people about and wrap up with. So with that, I would say thank you so much to all of our speakers. It has been an enlightening hour and a half from my perspective. I've definitely learned a few things. I think we've all really understood the impact of the extremely volatile times that we see and the requirement. I think it's something that you said, Mark, earlier when you were talking about attention to detail. That is going to be the key factor going forward. So I'd like to say thank you to all our speakers. And I'll quickly round up and finish the session. It has been a very volatile and uncertain time, and I think everything that we've heard this morning is that it is going to continue. And when we're talking about uncertainty, we're not talking about the next few months. Realistically, we're talking about a situation in world markets and domestic markets that could be impacting on our supply chains for many years, and that's the real time frame that we need to be thinking about. As David was saying a moment ago, with regards to the commodity prices almost masking some of the BPS losses that we're seeing, we must be thinking of these things in that 3 to 5 year period. And I think reviewing the farm business over that time period is a real critical thing. Understanding what's driving the market today in the short term and longer term is just one of the fundamental building blocks that we need to make those informed decisions, to balance that risk management portfolio across farm businesses. And again, as we just spoke about then, understanding the impacts on borrowing and working capital will be more and more important as we go through the next 12 to 18 months. So, with a few things to update on before we finish. It would be completely remiss of me on an AHDB webinar if I did not remind everyone that our voting platform for our Shape the Future vote is now open. We've had a good amount of people that have voted. We've had over 10,000 people register for the vote. It is open until early May, so there's another 2 or 3 weeks left for the voting period, and I would highly encourage everyone that has registered to vote to take part, to put forward their view. It definitely feels internally like it is a new AHDB that is being formed, and I think this is the key first step that we have to move towards that and to show that externally as well. So taking part in the Shape the Future vote is definitely something that I would say is a recommendation for the bank holiday weekend. Unfortunately, it looks like it's going to be good weather though, so we might all be outside doing other things. But in the evening, when we're relaxing, please go and vote. I can tick that straight off of my list. As I said earlier, we have a Q&A document that will be made of any questions that we've not asked today, as well as a review of the content that was covered in our Grain Market Daily publications for the rest of the week. If you would like to be signed up to any of our Grain Market Daily publications or any of the Horizon publications that David mentioned earlier on, please feel free to get in touch with us and we will make sure that we sign you up accordingly. I can again tick that off the list. We have our planting and variety survey, which is launching today. So this is our annual survey where we review pre-harvest what is in the ground. And this year, given all of the reasons that we've just been discussing over the last hour or so, it is even more important to understand, both from a domestic point of view, but also from an international point of view, the amount of grain that is going to be produced. We will really need to understand the import and export position that we're going to be in as a country to understand where we fit in with that global market. There will be an online portal that will be made available. We will be promoting that in our publications from today onwards. And again, along with the vote, I would strongly encourage and request all to take part in that so we can get a clear view of our planting and production potential well ahead of our harvest. In terms of other key pieces of work that we have upcoming from AHDB, we are in the process of discussing with industry the development of the grain passport, the digital grain passport. We are hoping to kick off that process in the mid-summer. It is again part of the vote to understand how important the move to a digital grain passport is to our levy payers. We are currently reviewing the system and we're having industry discussions with all of the main trade associations, farmers, as well as a key advisory panel to ensure that we're building and developing the right that is required for industry. Once we have a confirmation that that is ready to go ahead, we will click a big green button that we have in the office and the build will start and the digital passport will start to be built. We hope that we will then have a first cut of the product ready for early 2023, looking at feed wheat specifically, that we can then push out into the wider supply chains. Any other questions or comments around that, again, feel free to get in contact and discuss with us. The final thing that I should say is that we have an evaluation of today's webinar that will come up on your screens when the webinar closes. Again, it's hugely important, not only from the vote perspective, but also from the evaluation perspective of individual events, that we get your feedback so that we can adapt things and improve things and change things for the future, so that we can show that we are delivering the key insight and analysis that is required by levy payers and making sure that everything we're doing is value for money. So again, please do spare a couple more minutes of your time to fill in that evaluation. So without further ado, again, I will say thank you not only to all of the speakers today, but all of the people behind the scenes in AHDB that have helped create this webinar. Thank you all for your time in taking part. I do hope that you have found it a valuable time that you have spent with us and you have learned a few things this morning. If you have any other questions, feel free to send them through to us and we will endeavour to answer them. Other than that, I wish you a very good rest of your day, a good rest of the week. Have a great bank holiday weekend, and feel free to sign up to the rest of our publications to keep updated with all of the other work that AHDB is doing. So finally, thank you to our speakers, thank you to everyone attending, and I hope to have a great rest of your day. Take care, everyone. Thank you.